All right, we have some guests here. Mabel really loves money and banking. She's got to sit in the room and watch. Wendell, do you love money and banking?
No.
You don't? Why not?
Cause
I know you love money.
You love money. You have a piggy bank. He's not very good at saving, though.
That's right. Yeah, neither is his mother.
Knife to the heart. Have a good class.
Right. Maybe you got to sit down. All right. Hold on. Let me close the door. Okay. Yeah. So, there's a lot going on here behind the scenes and as I record these lectures, and I'm sure there's a lot going on with you where you're watching these lectures. So, I just hope that as things come up, make sure that you share them with me. I'm happy to listen. We can Zoom, we can talk on email. You can come visit me in my office hours, but as always, I want to be here and be a resource for you as we try to work through this class together. All right. So here's the last section of lecture for day one, right? The first day of money and banking here. And just spend the last couple of minutes talking about financial institutions, okay? Financial institutions. So we've talked a little bit about the Fed. We've talked a little bit about financial markets. Let's spend a couple of minutes talking about financial institutions, which is kind of the third of the three big topics that we're going to be talking about. So financial institutions are essentially intermediaries, and they specialize in indirect finance. By indirect finance, meaning they match people up. They match up savers with lenders. Savers with borrowers. They match up lenders with borrowers, right? So they essentially serve the matching purpose within our economy. There are a lot of financial intermediaries within the U.S. economy. In this class, our primary focus is going to be on commercial banks as the primary form of financial intermediation. But it's important to know that there are many different types of financial intermediaries, and let's just talk about these for a couple of minutes. All right, so I'm going to switch here to Table 3 of your book here. All right, so these are the types of financial intermediaries, and this kind of looks at their primary liabilities, meaning how they raise money, and then it also looks at their primary assets, meaning how they use this money. So commercial banks are going to be the main focus of this class, right? It would be great to talk about all these different types of financial intermediaries, but we don't have time to do that. Commercial banks, though if you understand how commercial banks operate, it's relatively easy or easier to kind of understand how some of these other financial intermediaries behave. So commercial banks, they typically raise money through deposits, and their primary assets are business and consumer loans. They hold some government securities, primarily T-bills, and they hold some municipal bonds, right? So they raise money through deposits, and they tend to lend money out through consumer and business loans and mortgages and holding T-bills. Savings and loans, all right? Savings and loans are very much like commercial banks, but they tend to specialize in mortgages. Mutual savings banks, once again, are very much like commercial banks. There's some technical differences between mutual savings banks and commercial banks that are not really that important for us. Mutual savings banks tend to specialize in mortgages. Credit unions are, once again, very much like commercial banks, but they tend to be organized around a specific group of people, right? So for instance, in Iowa City, the University of Iowa has a credit union that essentially provides financial services to University of Iowa employees, right? And you might be familiar with other credit unions in the towns that you grew up in. And credit unions, once again, tend to raise money through deposits, and they tend to use that money to provide consumer loans. So they also do some mortgage lending too. So all of those types of financial intermediaries are banks, or very close to being banks. Another type of financial intermediary would be the insurance companies, right? So like a life insurance company who raises money through premiums. And then what do they use that money for? Well, they invest that money in stocks and bonds and some mortgages, and they hold it knowing that they're probably going to, well, they will at some point have to make payouts to their customers when they die. Fire and casualty insurance companies, same idea. You pay a premium, they hold that money in a wide range of assets, knowing that they will periodically have to make out payments when there's some accident. Pension funds, same deal. Employers and employees make contributions to the pension funds. These pension funds then invested in bonds and stocks, knowing that at some point people will retire, and then they have to make payouts. The third type of financial intermediary is, we could call these investment intermediaries. And these are essentially ways that people can, these are essentially financial institutions that help people save for the future. Such as, let me first talk about a mutual fund. A mutual fund basically aggregates the savings of many, many people and puts it into a diversified holding of many different types of financial assets, right? So with a mutual fund, I could put $100 in a mutual fund that essentially buys me 100 shares of the mutual fund. What does the mutual fund then do with it? They put that money, they pool it among many, many different savers, and they buy a very diversified portfolio of assets. What's the advantage to me as a saver? The advantage is twofold. First, I can use the expertise of those professionals who manage the fund. And second, I get a lot more diversity than would ever be possible if I just had $100, right? $100, I can't buy even one share of most stocks, right? So now instead of having that $100 in that's not diversified at all, I can buy a little bit of hundreds and thousands of different types of assets, and it provides me a lot more safety and security than would be possible without that. So mutual funds are a great way for individuals to save. We talked about finance companies the first year. Finance companies are those banks that are associated with, for instance, consumer or retailers, right? So Ford Motor Credit or Target Credit Corporation, I think that's what it's called. These are essentially banks that are organized around consumer lending, and they tend to raise money by issuing commercial paper or issuing stocks or bonds. A money market mutual fund. Money market mutual funds are the same idea as a mutual fund. They tend to just hold very short-term assets, right? So they tend to hold money market instruments like T-bills and consumer paper. And then finally, hedge funds. And we won't talk much about hedge funds, but hedge funds are a form of a mutual fund, but with a couple of distinct differences. First off, usually when you put your money in a hedge fund, there's restrictions on how much you can pull out. So hedge funds, when you put money in there, it's usually going to stick in there for a long period of time. Second, hedge funds usually have minimum deposits, oftentimes $1 million. So these hedge funds are not for small savers, right? These are some bigger wealthier clients. And then finally, hedge funds tend to engage in more risky sorts of behaviors. So they tend to focus on high risk, high return sorts of behaviors, all right? But in essence, they're a mutual fund, right? They're a mutual fund, but with just some additional conditions attached, right? If you want to get some idea as to the relative size of all of these things, you can see why most of our attention is going to be on consumer banks, because they are the most important of the financial intermediaries. But you can also see the life insurance companies play a pretty big role in the economy. Pension funds obviously play a big role in the economy, particularly if you add in pension funds with state and local government retirement funds, which are just basically government retirement funds, right? Okay. Why do we need financial intermediaries? Why doesn't everybody just engage in direct finance? Why don't firms just borrow money through stocks and bonds? And the simple answer is because stocks and bonds are for the big players, right? So if I want to start a coffee shop in Mount Vernon, and to do that, I need to borrow $50,000. Could I go to Wall Street and try to issue some bonds that will allow me to raise $50,000? And the answer is no. $50,000 is small potatoes on Wall Street, right? I mean, some of these Wall Street guys, they saw $50,000 sitting on the ground, they may not even bother to bend over and pick it up, right? It's not a lot of money. And so how do small borrowers, where do they go? Well, they have to go to financial intermediaries, right? Particularly a commercial bank. Same with small savers, right? Mutual funds allow people the ability to save in small ways. Banks allow people the same ability, right? You can put $50 in a banking account, a checking account, or some of you might have $2 or $3 in your saving account, right? But it's a small way to save, right? And so financial intermediaries essentially work with small savers, small borrowers, right? That's the portion of the economy that they focus on. So they often kind of let the financial markets take care of the big players, the big institutional savers, the big institutional borrowers, and then, right, everybody else goes through financial intermediaries. Financial intermediaries, if we want to be more specific, why are they able to work where stocks and bonds markets don't? They have really, I would say, three big advantages when it comes to small savers and borrowers. First off, right, I'm going to switch here to my notes because I want to make this point clear. Financial intermediaries they really exist for three reasons. The first is financial intermediaries keep transaction costs down, right? It takes time and money to carry out transactions. And so what most financial intermediaries are able to do is they're able to take advantage of economies of scale, do a large number of transactions to keep the cost of each of these transactions down. So let me give you an example. Let's say that you tried to open your own bank in your dorm, right? And so you get all your friends to deposit money with you, and you allow them to issue credit cards, and you allow them to have a checking account. And before you know it, they are writing checks and using their credit card, and you have to keep track of all this stuff. It's going to be a pain in the butt, and it's going to be very costly for you. But the beautiful thing about banks is they've developed automated systems and use information technology to keep these costs just absolutely at a minimum. And the reason they can invest in all these things is because they have hundreds of thousands of customers, right? If you had 50 customers, they'd be too expensive to implement. But if you have hundreds of thousands, you can implement these and keep the costs way down. And that's essentially what banks do, right? They something like a checking account is actually quite expensive to administer, but banks keep those costs at the absolute minimum by using technology, right? And developing these systems. Financial intermediaries are also very important because they allow people to risk share, particularly small savers, small borrowers, right? If you put your money in a bank, the bank's going to lend that money out to hundreds of different people, right? And so it is a way to diversify, and it provides you a level of security. banks can diversify their assets that they lend out, but they also get to diversify their sources of funds, right? They don't borrow from just one person. They're borrowing from hundreds of different people. And that also allows them to share risk and reduce risk. Finally, the third reason, and this is something we're going to talk much more about tomorrow. In fact, not just tomorrow, but this is really going to be one of the big themes of this course, is this problem of asymmetric information. You cannot understand finance, you cannot understand financial systems unless you understand this issue of asymmetric information, right? Because this is essentially the fundamental problem that occurs when finance takes place. As we've talked about, finance is about trading money over time. And trading money over time means that there's an element of risk, okay? What specifically can we say about this risk? A lot of the risk comes from the fact that there is asymmetric information between borrowers and lenders. In other words, borrowers have better information than lenders, right? When I borrow money, I know more about how committed I am to repaying. I know more about what I'm going to do with the money, and I know whether I'm a good investment. I'm always going to know more than the person who lends me money. Borrowers have better information than lenders. Now, that has two very important implications, because that basically, the fact that information is not equal between borrower and lenders basically creates some weird incentives in finance. The first of these weird incentives takes place even before the loan happens, and this is called adverse selection. Okay, who's most likely to need a loan? Somebody who's a bad credit risk or good credit risk? Someone who's a bad credit risk is more likely to need a loan. So in other words, who's more likely to apply for a loan? Somebody who's not a good credit risk. So banks know this. Strangely enough, who would a bank prefer to lend money to? Somebody who walks in their door asking for a loan, or just somebody random off the street? Strangely enough, a bank would prefer to lend money to a random stranger than somebody who comes in asking for a loan. That's the environment that banks have to make decisions in, right? They know that everybody who comes in walks through their door is more likely to be higher risk, right? This actually refers to a famous article in economics called "The Market for Lemons," in which economist by the name of Akerlof, who won a Nobel Prize for this, asked, why would people ever buy a used car? Because what's true about a used car? A used car is being sold. Why is somebody selling it? Quite possibly because it's a crappy car. It's a lemon, right? Strangely enough, a random car on the street is likely to be better shape than a average used car, because that used car is more likely to be a lemon because the seller knows something more about that car than the buyer does. So this is a big problem in finance, and particularly for banks. They know that they have to worry about their customers being risky. Then there's a second problem. What happens after a customer gets a loan? Well, after they get a loan, there's another perverse incentive, and that's called moral hazard. And moral hazard comes about from the fact that people who have a loan are more likely to engage in risky behavior because they're using the bank's money instead of their own money. Right? So consider an example. You borrow money and you have two uses for that money. The first use was you could earn $20,000 by borrowing $1,000 with a 10% chance, but you could lose everything 90% of the time. Or your other option is just to earn $1,100 with a 100% chance. Which do you take if you're using a bank's money? Well, there's an argument to be made that option A is better because it has a much higher expected value, right? If you get the 20,000 bucks, you pay the bank back 1,000 and you keep 19,000 bucks. Ta-da, right? You're rich. You made out like a bandit. What happens if it doesn't work out? Well, then you stick the bank with 1,000 bucks, right? There's the moral hazard. I can stick the bank with the downside, but I get to keep the upside. That encourages me to engage in riskier behavior. The bank would love it if you did option B, right? Because in that case, they get repaid 100% of the time. But the problem is the bank's incentives are not your incentives as a borrower. You have more incentive to engage in risky behavior once you get a loan. And that's what moral hazard is. So asymmetric information that creates adverse selection and moral hazard influences every decision in finance. It influences every decision in finance. And so you have to understand how decisions are influenced by these two things to understand how finance really operates. And so that's where we're going to pick up tomorrow, right? Tomorrow, you have a reading from my book, the new book, that will be posted on Moodle. And so we were going to pick up and talk about that reading from the new book. And then also tomorrow, we're going to talk about chapter 3 in the Mishkin book on money. All right, so that will be where we pick up on day 2. All right, so that finishes it for day 1 of lecture. Make sure that you pay attention to your email and communication from me regarding ways to stay in touch and office hours, and then also pay attention to Moodle, where I will be posting things that might be of interest to you. All right, hope you all are well. Take care.